So today I want to talk about taxes and investing. I think in general, people need to think more about taxes when it comes to their investments and their decision-making process with their investments. Now, I do understand, and as you should understand, that there are different types of accounts, right? There are some accounts where it's tax-free while you're earning it, while you're spending it, while you're withdrawing it. It's just always tax-free. There are some where it's taxable all the time, and there are some where you can defer those taxes. So your outcomes will vary depending on the type of account. Keep that in mind as we talk a little bit about taxes here today. Now, when it comes to taxes, we can think about our investment returns in a couple of different ways, right? We have our total returns here. We can break that into capital gains. Now, so this would be the tax you pay on the appreciation of the asset. Now, I can't tell you how many times I've heard people talking about taxes and capital gains, and they act like that you're paying taxes on the full dollar amount that you sell. That's not true. You're only paying it on the gain. So if you bought something at 80 and sold it at 100, you're only paying gains on that 20% gain. I, again, cannot tell you how many times I've heard people talk about taxes as if that is not the case and that you had to pay taxes on that full $100. The other component of your total return, of course, is dividends. Now, when it comes to capital gains, we can further break that down into short-term capital gains and long-term capital gains, and the tax consequences of these different sources are in fact different. Now, dividends, it turns out, are they're just going to be taxed like any kind of income you get from your job. There's no special treatment for dividends. The same thing ends up being true for short-term capital gains. So if you hold an asset for less than 1 year, day traders, you end up paying short-term capital gains, which are the same as your marginal tax rate for your income. Long-term capital gains, so capital gains after holding an asset for a year or more, have very favorable tax rates depending on your income. Those rates could be zero, they could be 15%, they could be 20%. If you're super high net worth individual, lots of income and lots of capital gains, then you are subject to what's called a net investment income tax. That's kind of a flat 3.6% on those gains. And of course, this is all federal in nature, and each state has their own rules too. So keep that in mind. So what's your strategy going to be? Let's think about cost basis. So let's say you have some stock, you have 100 shares of ABC, you have 100 shares of XYZ, and you want to sell some of this. What might you think about doing? Well, let's take a look at the current price. Let's say, just to make this simple, that the current price is $50 for each one of these, but we actually bought these in kind of tranches. So you can think about breaking those down into the tranches where we have ABC, where we bought it at 40, half of it at 40, half of it at 30. For XYZ, we bought half at 40 and half at 55 versus the current price. Well, what about capital gain? So here we can see that the capital gain on the positions varies, right? So if you wanted to sell this, you would want to sell maybe the ones that have the smallest capital gain, or even sell the one that has the negative capital gain to offset some capital gains that you have to take. So that is a strategy you might think about in terms of cost basis tax efficiency. This is done by institutional investors and retail investors alike, but something you should definitely keep in mind. Another thing people you might want to think about, and I rarely hear people talk about this, it is part of, say, an optimizer, things like that, but let's say you held XYZ, right? And your forecast for that asset is it's going to have a 10% return. And there's another asset, ABC, that you don't have, and it has a higher expected return. The question is, should you do this trade? Well, it turns out it really depends on your capital gains. So let's say here's how holding XYZ would play out, right? We have our expected returns here. We just hold XYZ, we get that 10% return. So our portfolio grows in value to $110. Keep that in the back of your mind. The other option, of course, would be to sell XYZ and buy ABC. So if we were to do that, right, we start here with our position. We have XYZ. Now we're going to sell it. So on T time T0, we end up with $100. But don't forget, we had to pay taxes on that. So let's say that stock had doubled in value, okay, from our purchase price. So we're going to pay, and then with our capital gains tax is 15%. If that's the case, then after taxes, that $100 turns into $92.50 and grows then to $115.63, which is better than the $110 we saw for buying and holding XYZ. If we were to say, well, maybe this asset quadrupled in value, if that's the case, then we pay more taxes, we have more gains, and then we're about at a break-even point. So we could do this with a lot of different numbers. We could tweak these expected return numbers. We could tweak our capital gain. We could tweak our tax rate. The whole point here is when you're investing, you need to think about this net expected return, right? At some point, given each individual scenario, there's a trade-off. Like either you should just stay put or you actually should make the trade to get better. So keep that in mind and have a good time out there trading. Thank you so much. I'm Brian Kozlowski. I hope you enjoyed this.